What do you think is the major factor driving an investor's long-term wealth accumulation? Is it the specific mutual fund that they buy? Is it timing the market, jumping in and out just at the right time? Well, a landmark study by three academics, Brinson, Hood, and Biebauer, revealed that 91.5% of future wealth accumulation is driven by the asset allocation decision. It comes down to how much of your money did you invest in growth assets like stocks? How much did you put into fixed income like bonds? How much is remaining in cash equivalents like a bank checking account or a certificate of deposit? Determining the right asset allocation is the key to growing your wealth over time. Hi, I'm Harry Starn, and welcome back to another Starn Standard Practical Knowledge video. In this video, I will share how many financial advisors determine the appropriate portfolio mix for their clients. Specifically, you're going to gain knowledge about individual risk factors impacting the asset allocation decision, the foundational concepts of life cycle investing and portfolio optimization, how those two broad concepts are used in practice to determine the major asset allocations to stocks, bonds, and cash. Then, how those major allocations are further broken down to subcategories, and key factors to consider if and when selecting an investment advisor. It's extremely important that we start by discussing how a person's life circumstances and risk factors impact the final asset allocation decision. Any suggested asset mix based on the practical methodologies that you're going to learn in this recording is just the starting point. You always need to modify the starting portfolio mix for your personal circumstances and risk factors. Personal circumstances include your future financial need. What level of portfolio return is necessary to reach your goal? The time horizon. Are you investing for the short term, intermediate term, or long term? Your liquidity need. What's the likelihood that portfolio assets will need to be sold to help pay tomorrow's bills? Your cash inflows and outflows, your net worths, and any investment preferences and constraints. Risk factors include the investor's tolerance for market and security volatility, investment knowledge, and investing experience. A higher tolerance for volatility, greater investment knowledge, and more investing experience suggests that the person will be less likely to wake up in the middle of the night in a cold sweat saying, "Sell everything." In fact, there's a Wall Street saying that goes like this: invest down to your sleeping point. There are two approaches when thinking about asset allocation. One considers a person within their life cycle. The other uses quantitative analysis, the math, to optimize the risk-return profile of the portfolio. Life cycle investing suggests that an individual's wealth consists of two components: financial wealth and human capital wealth. Financial wealth includes your real and personal assets, your liquid financial assets like a bank account, and your investment assets. Your human capital wealth relates to a person's future earning capacity, a person's skills, their personal health, their professional and social networks, their academic degrees, and professional certifications contribute to their human capital. The premise behind life cycle investing is that early in one's professional life, human capital wealth is very high, while financial capacity, their financial wealth, is relatively low. Later in life, that flips. At this point, there'll be higher financial wealth with lower human capital wealth. According to life cycle investing, an individual should position a major portion of their investment portfolio into growth assets early in the career. That's because you can generate the cash flow needed by your work endeavors to pay for the bills. Later in the career, as one's ability to generate that systematic income, it's either limited or reduced, then the portfolio needs to shift more towards fixed income. That income from the portfolio will be used to replace these missing working income. In summary, the life cycle approach advocates that the greater the human capital, the greater the focus on growth investments, and the lower the human capital, the greater the focus on income-producing investments. Modern portfolio theory focuses on the math. It offers a statistical approach to finding the optimal asset mix. By applying calculus-based minimization techniques, the portfolio optimizer software can determine the asset mix that offers the highest level of return for a given level of risk. Or you can think of it, the lowest level of risk for a given level of return. All that's needed for the calculation is the expected return of each asset, the standard deviation of each asset, and the correlation coefficients between the various assets. Correlation coefficient captures how closely one security moves relative to the other. The image shown here depicts a sample frontier. It reveals the mix of securities or asset classes that provide the highest return. There are a couple challenges to this approach for an individual. First, we don't have a crystal ball. We don't know what the statistics will actually be moving forward. If you change one of those numbers, one of those statistics, then the recommended allocation completely changes. Other complicated issues include the liquidity need, the different sets of income taxes and other types of taxes we encounter, and limited lifetime. While the math reveals an optimal portfolio based on the numbers, that calculated mix may not be appropriate for the individual based on their circumstances and their risk factors. To deal with this, an investment advisor will set internal minimum and maximum percentages for each security or each of the asset classes. Those constraints help to create a portfolio that makes sense for the individual, while still benefiting from the risk-return optimization. Staying invested throughout market turbulence is a key factor for future success. Okay, let's shift our attention now to practical ways for individual investors to determine an appropriate portfolio mix. 3 practical approaches for determining that starting stock, bond, cash allocation are 100 minus your age, a 60-40 starting point, and asset allocation buckets. Let's look at these. The 100 minus your age approach acknowledges that early in one's life cycle, it makes sense to be heavily weighted in equities, since stocks are expected to grow over time at a rate that far outpaces inflation. For example, given that the person's age 30, then this approach suggests that 70% of the portfolio could be dedicated to growth assets, with 30% to fixed income and cash equivalents. What it doesn't mean is that each year the allocation to stocks drops by 1%. That's not the meaning at all. And likewise, the allocation to fixed income increases each year by 1%. The 70-30 stock mix in this example is just a starting point for refinement. You need to then consider if that starting allocation should be fine-tuned based on the individual circumstances and risk factors. A second approach is to start from a 60-40 stock-bond mix and then adjust upward or downward based on the individual's situation. For example, an aggressive investor with an intermediate to long-term time horizon might shift from 60-40 to 70-30, maybe 80-20 stock bond mix. In contrast, the moderate investor, the conservative investor, might reduce the growth component so that the mix drops from 60-40 to 50-50, 40-60, or maybe even below that as you're looking at it. A third approach that's often used by professional advisors is the bucket approach. With this methodology, the financial services firm that the advisor works for establishes the stock bond mix. The advisor's role is to know their client so that the advisor realizes into which bucket would be appropriate. Now notice how these allocations closely align with the 60-40 adjustment just described. The middle bucket and the starting point from last methodology is 60-40. That investor is identified here as a moderate risk tolerance. For investors with higher risk tolerance, the allocation shifts to 70-30 and to 80-20. Similarly, for investors with a lower tolerance for market volatility, the allocation is reduced to 50-50, 40-60, or below that. Again, the wealth manager here has the discretion of fine-tuning the buckets for individual circumstances and factors. Now that your major allocation percentages to stocks, bonds, and cash equivalents is determined, it's time to decide on how you want to subdivide the investment dollars. For discussion purposes, let's say that your appropriate starting allocation is 65% equity stocks, 30% fixed income bonds, and 5% cash equivalents, which you determine you need for liquidity. How will you determine how much of that 65% to subdivide into different sectors of the equity market? For example, how much we put in large cap, mid cap, or small cap stocks. Wealth managers will often use modern portfolio theory, again, setting some maximum and minimum constraints in determining the suballocations. Practical applications to suballocation include dividing your money so that most goes into large cap securities with smaller amounts into mid and small cap securities. The equal weighting. Broad diversification with some tilting towards a sector or a style. The pyramid on this slide reveals how many wealth managers will outweight the stock portfolio towards large cap securities, both domestic and international. These well-established firms typically pay dividends and experience less market volatility compared to the mid and small cap securities. Throughout this discussion, we focused on the traditional asset classes, stocks, bonds, and cash equivalents. You might consider expanding to beyond the traditional mix to include real estate and other forms of alternative investments, including maybe mutual funds, offering exposure to currencies, commodities, and hedge fund-like strategies. Now, you may want to meet with an investment professional, perhaps a CFA or CFP, if your investment situation is complicated or you're new to investing. If you do that, I trust that the information you learned in this video will promote meaningful conversations. If you have not already selected an investment advisor, then there's 3 attributes that you should consider. First, you're looking for the appropriate credentials. That demonstrates the individual has the technical knowledge to help you. 2, an unwavering high ethical standard. And 3, a focus on you and your family. All 3 are important, but of the 3, I believe you should always weigh high ethical standards as the non-negotiable. In this video, you are provided with practical financial knowledge on how many advisors help their clients determine an appropriate asset allocation. Specifically, you learned about individual risk factors and how they impact the asset allocation decision. the foundational concepts of life cycle investing and portfolio optimization, practical applications to determine the major asset allocations to stocks, bonds, and cash equivalents, the subdivision of those major categories, and key factors to consider when selecting an investment advisor. Remember, your asset allocation plays a huge role in the future of your wealth accumulation. Well, thank you for watching this practical knowledge Stern Standard video. I hope that you found the information useful for positioning your portfolio for that long-term growth. I invite you to watch other videos that I've posted on personal investment planning or other relevant pieces of the personal financial planning puzzle. If you enjoyed the video, then please take a moment and hit the like button and consider subscribing to the Stern Standard channel. Well, have a great day and see you in the next video.